Paramount is the latest streaming company to report, and the stock is plunging here today by about 2.5%. Despite a record quarterly user gain for Paramount Plus, the media giant saw losses from streaming investments escalate there and delivered weak ad revenue for the quarter. RBC Capital Markets Media, Cable, and Telecom Analyst Kutgun Maral joins us now. Kutgun, take us into your analysis for Paramount's quarter here.
Yeah, of course. Thanks for having me. And I think, the quarter itself, while challenged, was broadly in line or solid relative to expectations from Wall Street. When you think about direct-to-consumer subscriber growth, revenue trends with, again, albeit with unsurprising softness in advertising, and profitability. I think for me, the biggest concern in the quarter specifically was free cash flow, which was, again, quite challenged and below expectations for a second consecutive quarter. And I think will continue to be an area of investor debate. Going back to the earnings call about an hour ago, management talked about the 2023 outlook and highlighted, that they were particularly transparent about some of the challenges that they're seeing in terms of the ad market, likely remaining pressured until probably the back half of this year. And of course, continued investments in direct to consumer weighing on profitability and free cash flow. So I think there's no question that all traditional media companies are going through a massive transition right now. And some of them are a little bit ahead of the curve in terms of reaching that inflection point in peak losses and going on an improved path towards break even and hopefully profitability. In terms of Paramount, I think maybe they're a year behind in that transition process, but there are clearly a lot of positives to think about if you have the I think patience to look to 2024, especially as they benefit from the price increases that were mentioned earlier, as well as the benefits from the combined Paramount Plus and Showtime service.
And Kutgun, I want to pick up on those price increases. We have the premium Paramount Plus tier with Showtime. That's going to now cost $11.99, up from $9.99. The essential Paramount tier with ads, that will be $5.99, up from $4.99. Now, this service, it's always prided itself on being a value player in this space. What are your thoughts on those price changes, especially in relation to competitors? Is it priced correctly?
We'll have to see. I think the reality is when you combine those two services, the utility that the consumer gets is far improved. And I think what a lot of these companies are discovering is that when they first came to market, you go back 2-3 years ago, everyone was trying to compete with Netflix and scale aggressively with less of an eye on profitability and the timelines around reaching break even and profitability, and clearly a lot bigger focus on subscriber growth. Now, as you pointed out earlier, everyone's tweaking the model, whether it be opportunities on revenue and clearly a lot of optimization on the cost structure. And I do think that the utility that consumers get is relatively high on a lot of these platforms. I know as consumers, we might complain about them, but the investments that these companies have made in terms of the offerings, the original content, the licensed content, sports programming, film, I think all these things give management at least the confidence to be able to push through these price increases and hopefully benefit from increased churn just purely because of the investments that they made on programming and hopefully not see massive churn as we all expected that they would maybe a year or two ago.
As you say, that we've sort of seen a bit of a transfer, a different focus, right, for many of these media companies. I think about a Disney now with a Bob Iger back at the helm, which right now is leaning more into theme parks because that's what's working and really trying to find more discipline on the streaming side of the business. How is that balance, though, working at Paramount, which does not have that juggernaut of a theme park operation?
They certainly do not. And from Paramount's perspective, I think their task is really balancing this pivot towards streaming along with the traditional linear assets, which, while in decline, continues to drive a lot of the profitability and, of course, the free cash flow for the company. And it's all a matter of making sure that balance towards this growth profile that they hope to scale in and ultimately benefit from an earnings perspective is disciplined and in a measured way. And I think that's a big challenge, especially as despite these stocks, a lot of these media stocks are up, 30, 40, 50% year to date. I would say that we're kind of in the moment of peak negativity in terms of streaming sentiments, especially for some of these platforms that have not convinced investors that they will be the top 3-4 player on a global basis in the long run. And so right now, everything that these companies can do is, again, tweak the model to make sure that they're right-sizing the top line opportunity, effectively monetizing the consumer, and certainly improve the cost base. And you're seeing a rationalization in many, many different ways. Bob Iger talked about looking at, he dropped a lot of bombshells in many ways about, rethinking the content investments, rethinking pricing, the markets that they operate in, content exclusivity, content licensing. And when it comes to Paramount, I think it is a profound shift in the way that they operate when they're about to integrate Paramount Plus with Showtime. And I think there might be some concerns about what the immediate subscriber impact of that might be. But the reality of the business is, that should drive efficiencies to the tune of $700 million in future annual spend across content spend, tech costs, and marketing. And again, the entire focus right now from a Wall Street perspective is getting to profitability and growing afterwards.